This is Tom Aspray with the Viper Market Wrap video for the week ending June 13th. Well, stock market looked pretty good after Thursday's close. A couple of weaker or lower than expected inflation numbers from the CPI and the PPI was a nice sign, as it suggested that maybe inflation expectations by the consumer would be going lower. However, that changed as Israel started bombing Iran's nuclear facilities, and unfortunately, as of Sunday, the tensions haven't let up. Of course, the surge in the crude oil prices was not a good news for the stock market. Most of the averages were lower by the close. You can see the S&P weekly here was down 0.36%. No real increase in volume. AD line was down a little bit. Breadth was positive going into Friday, but Friday's numbers were not. And you can see on the sentiment front, the nice uptrend. We've been expecting this to move back up this week, and next week could be a challenge, but it appears to be starting a new uptrend there. For the New York Composite, also, down about 0.32%. Slightly lower highs in the stock's only AD line. So it's, it is diverging, but really on a short-term basis. It's the longer-term divergences that often warn of a more serious decline. Still, we need to be on the lookout for how this decline measures out. Best case scenario, and more likely the way it happened, is that this is going to be a brief affair, and they'll be followed by some churning and likely more on the upside. Anyway, I see all-18 does look a little better. No real divergences there after its breakout. Trading range breakout here, as I mentioned before, usually 1.5 months afterwards does not seem like enough of a rally to support that. The more positive outlook is also consistent with what I see in the Qs. They were down 0.56%, but clearly look stronger. Higher highs in the AD line. The 20-day EMA here is in blue. It's at, and you can see the RS is also positive. And if you look at the daily chart, you'll see that we hit the R1 almost exactly. So support here around 521 down to 507. AD line on a daily basis still looks strong. Sharply higher highs. That's a positive sign. So, still above its moving average. So, if it drops below its moving average, don't be looking at this support and then the breakout level down here. RS still suggests the Qs are leading the SPY. The daily chart of the SPY and the S&P shows, higher highs over the past month. But in the AD line, lower highs. Okay, so, we're testing the moving average with Friday's close. So we'll be looking at the support here initially, and then, of course, the breakout level. So could get wild. Don't see any reason to panic out, but you should use stops and oppositions, and it'll be important to see what the markets do in the first couple of days of trading. Stock's only AD line did not make lower highs, and the all AD line on a daily basis also looks much stronger. So that supports the action, in the Qs also. So on the weight of the evidence basis, that's definitely a good sign. Friday's numbers were pretty bad. You can see 553 advancing, 2251 declines. About the same on the Nasdaq, and on both there were more new lows than new highs. Not substantial pickup in the new lows at this stage. The Nasdaq Composite, you can see, a slight pickup here, but not, anything near. So, if we get above 250 or so, that might get more attention. Easier to look at the NYSE Composite. We've got 44 and 60, but you can see that in early April, I think it was more like 120 or so. So not a problem there. If you look at, the VIX did pick up its head a little bit. Okay, well, this is the put-call ratio. Sorry, no signs of put buying here, so that's interesting. That will definitely change in I would think in Monday's numbers. Some of the people who run models say that with last week's action, the put-call data has turned more negative. We'll see. Here's a chart of the VIX. It kind of turned up slightly above its moving average at 20. So you can see this 25 level here probably. That'll be the next place it should slow down on the upside. So we'll see if it does. Based on the RS as well as our growth value ratio, growth is still the place to be, though it's getting further above its moving average. So like anything, we could see some of a reversion, and we did a slight improvement in some of the numbers on the value next week that have been getting hit pretty good. So would not rule that out. Still looking at XLK, FDN, VGT. They're still looking pretty good and still suggests that just a pullback is likely, not a significant top. Doing a shorter update today because of the Father's Day holiday and improvement. Generally 61.1% of the ETFs closed over their quarterly pivots. New positive weekly signals in PSC, that's a small cap energy ETF, IXJ's healthcare, VDE, XES, and XLE. Healthcare did act a lot better. We'll show you some charts of that later, but not. There was some signs that in the short, leveraged short ones that there was some improvement in the daily DTS and some deterioration in the leveraged long. Only 50% were positive. If you look at the grid, of course, the main improvement was in the energy. It was 3 weeks ago. It was 50, 58.3, 100. Okay. XLB fell off, but XLI is still staying negative now, so I'll be looking at the charts there since we do have a position. XLP, not great, 91.7 on XLV on healthcare. That's the best reading we have going back to the start of the year. So that is interesting. The financials got hit on Friday. Jack to 45, still positive in XLK and XLC. Always important to look like over the past 3 months. 3 ETFs did better than the S&P. S&P was up 8.6%. XLK was up 15.4. XLI was up 11.1, or XLI was up 11.1, and XLY was up 10.2. New weekly DTS on XLE. Not any other ones. XLY is still red. VHT, healthcare, despite its rally, is still red, as is ITB. The 3 DTS, XLP and XLF, and XLF also had a daily on Friday. So, you can see where the selling was concentrated. XLI, XLB, XLC, IWM, and ITB, and then TQQQ. So we'll be watching with, of course the question is whether these DTSs will morph into 3 DTSs. So we'll be tracking that at the start of the week and let our subscribers know if there are any significant changes there. And in terms of the relative performance, energy finally moved above. The green is the fast moving average, moved above the slower one. It's been pretty much negative, for most of the year. Technology still looks strong. Healthcare looks like it's trying to bottom. And the financials, the prices started to act like the relative performance, which has been basically negative here since May, and just continue to drop further. Let's drill down quickly on the sector report. You can see weekly DTS, XOM, Oxy, EOG, COP, and HES. 100% 3 DTS. Not much in the red column here. So, that looks like, what typically that means. You don't chase the market, but you look for a pullback. See where those energy stocks open the week, and that's kind of might be a benchmark for you. Materials, 81.8. RS chart is not great. Dow give a new weekly buy. So a couple of the chemicals do look interesting. Industrials, no question. We have to see, the defense stocks, which are in this, are starting to do considerably better. 83.3. That's a pretty good strong reading. Consumer discretionary, not so much. You can see lots of red, not much new green, except Tesla closed above its quarterly pivot, but it's 3 DTS and DTS and daily DTS are both negative. So, Amazon's one of the few, Chipotle and Starbucks. So, have a coffee, a burrito, and shop at Amazon, I guess is the message here. So, in the consumer staples, Target, still Walmart and Costco are still all red here. Dollar General, no surprise, and Pepsi. If you go with that instead of the coffee for your lunch, and Clorox down here also gave a new 3 DTS buy. Healthcare, so what should we be looking at? J&J and Merck both gave 3 DTS, and if you look at things like United Healthcare, it's really gotten smacked. So some of those are going to probably bounce, but if this is a real turn, we'll have some time to establish long positions. Lots of red, in the financials. JPM, Bank of America, all pretty weak. Technology, a mixed bag, mostly green, and so we don't want to see that change in terms of the major trend. AMD turned daily DTS, as with CRM, Adobe, and Intuit. And communications, still holding pretty good. The relative performance chart sort of, chop city, but the overall technical action of XLC still looks pretty good. Google's has some 4-hour, but no daily yet. And then lastly, the utilities still acting pretty weak, but interesting. There could probably, if the market does correct a little bit more, we're going to see the security or the low risk play, into the utilities as well as the staples. We could also see more flight to quality in the bond market. You can see the notes closed down. Still looks bearish. If we break this support at around 4.326, we're likely headed down to the 4.2 to 4.141 area. That would, help the stock market a little bit, and won't do the dollar any good because lower rates are usually negative for the dollar. But the 10-year note looks the most negative going into the new week of trading. On the economic front, we get your Empire State Manufacturing Monday, retail sales Tuesday, housing start, building permits, and of course the FOMC meets on Tuesday, so an interest rate decision and a press conference on Wednesday. That's always fun. And then, leading indicators and the Philadelphia Fed Manufacturing Survey on Friday. So that's pretty much all I have for today. Going to go spend some time with some family, and if you want more information on our services, go to theviperreport.com, and you can subscribe to either service here. We've been doing quite well since the April lows, which we correctly called, and I think that trend is going to continue into the summer months. Hope you enjoy the video. Please send, as always, your comments and questions.